Good morning. Let's talk about why cap rate doesn't always tell the whole story. And if you're investing in commercial real estate in Houston, Katy, or anywhere in Texas for that matter, you've heard it. What's the cap rate? And cap rate is important, but it's an incomplete financial tool. And as a commercial mortgage broker with Medallion Funds, I can tell you very directly lenders don't finance cap rates, they finance the risk, the structure, and the cash flow durability. So let's break this down a little more properly for you. What is a cap rate? A cap rate or capitalization rate is basically just your net operating income divided by your purchase price. And what it does is it measures unleveraged yield, meaning it ignores the debt. So an example, if you got a net operating income of 500,000 and a purchase price of 10 million, your cap rate is going to be 5%. And that's fine as a pricing metric, an evaluation metric. But here's the problem. Cap rate ignores financing structure. And cap rate assumes you paid full cash for the property. And most investors don't, is the takeaway. And the difference between the two, say 65% loan to value at 6.75 versus 75% loan to value at 8.25 bridge, or an 80 LTV with an interest only, or an SBA 7A versus a conventional purchase, or a bank versus a debt fund option. All of those can completely change your cash on cash return, your debt service coverage ratio, but also your exit flexibility. So risk profile matters. And at Medallion Funds, we routinely see, say, a 6.5% cap deal outperforming a 7.25% cap deal because the capital stack was structured correctly and we maximized their financing. And the point is, structure beats your sticker cap rate. 2, cap rate doesn't show risk. So a 7.5% cap rate might look more attractive from a numbers perspective. But then if you ask a few more questions, you may get a different answer. So let's look at what's the tenant credit quality, or what's the lease term remaining? Are the rents in line or below market right now? And is there rollover risk in the next 18 months? Is there deferred maintenance that we need to remedy? And is there a balloon maturity timing issue that you need to look at? And what lenders do is they're going to analyze the debt yield, but also the lease maturity schedule and the guarantor's liquidity, and look at what the exit cap assumptions would be. So the point is, the cap rate alone does not measure the durability of your cash flow. 3 is cap rates don't reflect growth. So 2 identical cap rates could potentially have very different futures. So let's give you an example. Let's look at property A, where we've got static rents in a tertiary market with limited population growth. Whereas property B is in the Houston MSA growth quarter, and there's new residential rooftops nearby and strong retail pad absorption, but there's also medical expansion nearby. Same cap rates, but completely different appreciation curves. And markets like Katy, Fulshire, and West Houston behave differently than tertiary flat growth metros. So cap rate does not account for leverage strategy. And in commercial mortgage underwriting, we care about a few things a little bit more, particularly the debt service coverage ratio, the debt yield, as well as the interest coverage and potential refinance risk. And along with that comes prepayment structures. So a deal with a 1.5 debt coverage ratio and a strong debt yield with a corporate tenant will finance more efficiently than a higher cap rate with, say, 1.15 in debt coverage and a little weaker tenant mix, but also shorter lease terms. And that directly impacts your potential internal rate of return on your investment. So look at the financing as well. And 5, cap rates don't predict your exit. Exit cap rate expansion is a real thing. So if you buy, say, at a 6% cap rate, but then exit at a 7.25 cap rate, valuation compression can erase years of your potential cash flow. So sophisticated investors will model a few things to make sure they're making the right decision, but also stabilize refinances, looking at that, looking at your cap rate sensitivity on exits, and where we're at in the interest rate cycles, and if there's a debt maturity wave coming. And that's the lens that lenders use in 2026. So let's talk a little more about what lenders actually look at. And when we structure loans at Medallion Funds, we analyze it from a few different metrics: the debt yield, the global cash flow, your lease term and credit, but also the guarantor's liquidity and net worth, as well as the exit strategy and the market depth. Cap rate is just one input. So the bottom line for the day is that cap rate is a pricing metric and a valuation metric. What it is not is a risk metric or a financing metric or a growth metric or a strategy metric. And smart investors will ask a few questions, starting with, say, how does this deal perform under stress? So if you want to structure a commercial mortgage properly or evaluate a deal beyond cap rate, that's exactly what we do. So let's analyze the structure, not just the headline yield. Please visit billrapponline.com to figure out how to get a hold of me. Love to talk to you more and walk you through whatever you're facing. Have a good day.